October 29, 1929. The New York Stock Exchange opens for business like any other Tuesday. Except it isn't like any other Tuesday. In the next 8 hours, $14 billion will vanish. Not stolen, not hidden somewhere. Just gone. That's roughly $250 billion in today's money. Evaporated before lunch. But here's what's really wild. The crash wasn't the worst part. The crash was just the opening act. What followed was 10 years of misery. 1 in 4 Americans out of work. 9,000 banks wiped off the map. Families losing everything they'd spent their whole lives building. A decade so brutal it got its own name. The Great Depression, and it all started with something almost embarrassingly simple. Everyone decided that stocks could only go up. Spoiler. They couldn't. To understand how everything fell apart. You first need to understand how good things felt. The 1920s in America were genuinely extraordinary. World War I was over. America had emerged as the richest, most powerful nation on earth. Factories were churning out cars, radios, refrigerators, things that had barely existed a generation earlier. The economy was booming. Cities were exploding in size. Life felt electric. This era even has a nickname, the Roaring Twenties. And it roared. Jazz music, speakeasies, flappers dancing the Charleston. If Scott Fitzgerald writing about parties that never seemed to end. And then there was the stock market. Now. Investing in stocks wasn't new. But in the 1920s, it became something different. It became a national pastime. A get-rich-quick religion with ticker tape instead of scripture. Between 1920 and 1929, the Dow Jones Industrial Average, basically a scoreboard for the stock market, climbed nearly 500%. 500%. Your grandfather's $1,000 investment in 1920 would be worth $6,000 by 1929. Everybody wanted in. Housewives, factory workers, cab drivers. The guy who shined your shoes in the morning was giving you stock tips by afternoon. Just a normal day in the 1920s. But here's the thing that made this boom different and dangerous. Most of these people weren't buying stocks with money they actually had. They were buying on margin. Margin investing. Translation: you put down a small deposit, sometimes as little as 10%, and a broker lends you the rest. So you put up $100, borrow $900, and buy $1,000 worth of stock. If the stock goes up 10%, you've doubled your money. Genius, right? Right. Until the stock goes down. But nobody was thinking about that. Because stocks hadn't gone down. Not really. Not for years. And in the great tradition of humans convinced that the party will never end, everyone just kept dancing. Enter Herbert Hoover, newly elected president in 1928, former Secretary of Commerce. Stanford-educated engineer, a man so confident in America's economic future that he declared, and I want you to really hear this, that America was nearer to the final triumph over poverty than ever before in the history of any land. He said that in 1908. He was spectacularly wrong. So let's talk about how a perfectly good economy turned into the world's most dangerous Jenga tower. The stock market boom of the 1920s wasn't entirely made up. Real companies were making real money. Ford was selling real cars. Radio Corporation of America, RCA, was bringing radio into every American home. These were genuine innovations generating genuine profits. But somewhere along the way, the stock prices stopped tracking the actual value of companies and started tracking something else entirely. The belief that someone else would always pay more. Economists call this speculative mania. You can call it the vibes economy. Stock prices went up because people believed they'd keep going up. And they kept going up because prices kept going up. A self-fulfilling prophecy. Beautiful while it lasts, The margin system we talked about. It turned that spiral into a rocket ship. Here's how the feedback loop worked. Stocks go up. Your margined investment gains value. Your broker lets you borrow even more against that gain. You buy more stock. Prices go up again. Repeat. Everybody's getting richer on paper. Nobody's asking whether any of this is real. Imagined conversation at a dinner party. 1928, my broker says I'm up 40% this year. Mine too. I put in my entire savings in January. Good man. What does your wife think? She put in the rest. And it wasn't just individual investors. Banks were doing this too. Banks that were supposed to be safely holding your deposits were instead lending those deposits out to fund stock speculation. Because it was so profitable. Because what could go wrong? Meanwhile, there was a holding company craze. Investors would create a company whose only asset was stock in other companies. Those companies might themselves own stock in other companies. Layer after layer of financial paper, all propped up by the assumption that the stocks at the very bottom of the pyramid would keep rising forever. It was financial origami. Impressive to look at. Structurally terrifying. Now, here's where the Federal Reserve, America's central bank, comes in. And not in a good way. Throughout the 1920s, the Fed kept interest rates low. Cheap money means easy borrowing. Easy borrowing means more investing. More investing means prices go up. And when prices go up, nobody is calling the Fed to complain. There were voices of warning. Economist Roger Babson gave a speech in September 1929 predicting a crash. The market actually dipped that day. Then it rebounded. And the experts, the people who were supposed to know better, publicly mocked him. Yale economist Irving Fisher, arguably the most famous economist in America at the time, said stocks had reached what he called a permanently high plateau. That was October 15, 1929. 2 weeks later, the plateau fell off a cliff. But here's what makes this story genuinely heartbreaking. Not just a financial cautionary tale. While Wall Street was partying, the rest of America was already struggling. Farmers had been in crisis for years. After World War I, European agriculture recovered, and American food prices collapsed. Rural banks started failing as early as the mid-1920s, hundreds of them. Nobody on Wall Street seemed to notice or care. Industrial workers were being laid off as factories automated. Wages were stagnant for millions of Americans even as stock prices surged. The economy that looked so spectacular from the top of a Manhattan skyscraper looked very different from a Kansas wheat field. The Roaring Twenties weren't roaring for everyone. But the people making the decisions were the ones at the party. By summer 1929, a few cracks started showing. Steel production was down. Car sales were slowing. Housing starts had dropped. Consumer debt, the money ordinary people owed, was climbing. But the stock market, still going up. Because the market had, at this point, essentially disconnected from reality. It was running on belief, on momentum, on the deeply human conviction that what's been going up will keep going up. What they didn't know, what nobody wanted to admit, was that the tower had already started swaying. September 1929, the market starts feeling wobbly. Stocks slip a few percent here and there. Nothing catastrophic, just turbulence. Investors tell themselves it's a healthy correction, a buying opportunity. Even. Then comes October. Thursday, October 24th, Black Thursday. The opening bell rings and all hell breaks loose. Sell orders flood in faster than the system can handle. The ticker tape, the machine that reports prices, falls 90 minutes behind. Investors across the country are watching prices that are already ancient history, with no idea how far things have actually fallen. Panic spreads like a fever. Brokers are screaming, phones are ringing off the hook. Margin calls start going out. Those investors who bought on 10% deposits. The brokers are calling in the loans. Pay up. Now in a dramatic attempt to stop the bleeding. A group of powerful New York bankers pull $250 million and start buying stocks publicly, visibly. The idea: show the market that the smart money is buying, not selling. It works. Sort of. Prices stabilize. The weekend arrives. People breathe. Then comes Monday. The brief calm is shattered. Selling resumes. And then Tuesday arrives. Tuesday, October 29th. Black Tuesday. The worst single day in stock market history at that point. 16 million shares traded. A record that would stand for decades. Prices collapse. Companies that had been worth hundreds of millions are worth almost nothing by closing bell. In a single day, $14 billion in market value disappears. The bankers who tried to prop up the market on Thursday, they gave up. Now, here's the thing people often misunderstand. The market crash hurt a lot of investors, but investors weren't the majority of Americans. Most people didn't own stocks. What turned a market crash into the Great Depression was what happened next. To the banks. Remember those banks that had lent out their depositors money to fund stock speculation? When the stocks crashed, those loans went bad. Banks started running out of cash. And when word got out, when ordinary people heard that their bank might be in trouble, they did the completely logical thing. They ran to the bank to get their money out. All of them. At the same time, a bank run. And a bank run is self-fulfilling. The more people try to pull their money out, the faster the bank fails, which makes more people try to pull their money out. Bank after bank after bank. Between 1930 and 1933, roughly 9,000 American banks failed. 9,000. There was no federal deposit insurance back then. No safety net. When your bank failed, your savings was simply gone. Decades of work, your kid's college fund, your retirement, gone. In the background, President Hoover kept insisting recovery was imminent. The economy was fundamentally sound. Prosperity was just round the corner. It was not round the corner. In 1930. Unemployment was round 9%. By 1932, it was 25%. 1 in 4 Americans couldn't find work. And for those who had jobs, wages had been slashed. The party was definitively over. Let me paint you a picture of 1930 to America. Shanty towns spring up on the edges of cities. People call them Hoovervilles. After the president they blame. Men in suits stand in breadlines. Families pack everything they own into broken-down cars and drive west, chasing rumors of jobs that don't exist. Oklahoma, Kansas, Texas, the agricultural heartland, gets hit by years of devastating drought on top of economic collapse. The soil literally blows away. They call it the Dust Bowl. This is the Great Depression. Not just a financial statistic. A human catastrophe. Hoover's response: austerity. Balance the budget. Don't interfere with markets. Let the economy self-correct. He genuinely believed, as many economists of his era did, that government intervention would only make things worse. History was not kind to this theory. In 1932, Americans voted Herbert Hoover out of office by one of the largest landslides in history. They voted in Franklin Delano Roosevelt, FDR, who came in with a completely different philosophy. Government should act aggressively, immediately. FDR's first inaugural address. March 4th, 1933 *. The only thing we have to fear is fear itself. And then he got to work. FDR launched the New Deal, a massive package of government programs, regulations, and economic interventions. Public works projects that put millions of Americans back to work building dams, roads, schools, and national parks. The Social Security Act, the Securities Exchange Act, which created the SEC to regulate the stock market. And critically, the Glass-Steagall Act, which separated regular commercial banking from speculative investment banking. No more banks gambling with your deposits. Did the New Deal and the Depression? Historians still argue about this. The economy improved significantly, but full recovery, full employment, didn't really arrive until World War II ramped up American industrial production to extraordinary levels. The Depression lasted a full decade, and it didn't stay in America. The global economy was deeply interconnected. Even in 1929, American banks had lent heavily to European countries rebuilding after World War I. When those banks collapsed, the money stopped flowing. Germany's fragile Weimar Republic, already struggling, was hit catastrophically. Unemployment soared. The middle class was wiped out. Political extremism filled the vacuum. We don't need to spell out where that road led. The Great Depression didn't just end the Roaring Twenties. It reshaped the entire 20th century. So what do we do with all of this? The guardrails built after 1929. Deposit insurance, the SEC, Glass-Steagall, market regulations held the financial system together for decades. Then, slowly, many of them were weakened or dismantled. Glass-Steagall was repealed in 1999. Regulations were loosened throughout the 2000s in the name of financial innovation, and in 2008, the largest financial crisis since the Great Depression hit. Different in its details, eerily similar in its structure. Excessive leverage, complex financial instruments nobody fully understood, and the universal conviction that housing prices could only go up. Spoiler, they couldn't. The machinery of boom and bust doesn't retire. It just waits. Here's the question I'll leave you with. Every bubble in history. The South Sea Company, Tulip Mania, the dot-com crash, 2008, 1929, has had people inside it who could see the warning signs, who watched the leverage climb and the prices detach from reality and the crowd stop asking basic questions. Some of them said something, most of them didn't, because the party was too good and the profits were too real, and nobody wants to be the person who says it might end. So the next time someone tells you that prices can only go up, that this time is different, that the fundamentals have changed, and the old rules don't apply anymore. Remember, October 29th, 1929, and maybe ask a few questions. Now you know how the richest country on earth lost a decade, and why it could happen again. Like, subscribe, and hit the bell for more financial disasters explained simply. Share this video with a friend who thinks the stock market only goes up.